Expansion. Expanding the business. Internal finance. Sources of money from inside the business. Retain profit. Money left over that can be recycled into the business. Short-term sources of finance. Money borrowed for less than a year. Trade credit. Buying resources and paying for them at a later date, usually within 30 to 90 days. Long-term sources of finance. Money borrowed for more than a year. Owner's capital. Capital injected into the business from the owners. Working capital. Funds left over to meet day-to-day expenses after current debts have been paid. Current assets, current liabilities. Cash flow. The flow of money into and out of a business. Cash inflows. Flow of money into a business. Cash outflows. Flow of money out of the business. Cash flow forecasts. The prediction of all expected receipts and expenses of a business of a future time period which shows the expected cash balance of the end of the month. Reasons for cash flow forecasts. Seeing cash shortages, supporting applications for funding, help when planning and monitoring cash flow. Liquid asset. Asset easily changed into cash. Net cash flow. Difference between cash flowing in and cash flowing out of a business. Costs. Expenses that must be met. Fixed costs. Costs that do not vary with level of output. Variable costs. Costs which rise as output levels are increased. Total costs. Fixed costs plus variable costs. Direct and indirect costs. Direct equals one thing, raw materials. Indirect equals many unspecific things, rent. Total revenue. The money generated from sale of output, price multiplied by quantity. Total profit. Total revenue, total costs. Break even. When a business's total costs and total revenue are exactly the same. Break-even point. Fixed cost selling price, variable cost per unit. Profit and loss accounts. Shows the income and expenses of a business during the financial year. Distributed profit. Profit that is returned to the owners of a business. Dividend. The portion of corporate profits paid out to stockholders. Gross profit. Sales revenue, cost of goods sold. Net profit. Gross profit, expenses. Balance sheets. A summary at a point in time of business assets, liabilities, and capital. Assets. Resources owned by the business in production. Capital. A source of funds provided by the owners of the business. They are used to buy assets. Current assets. Assets likely to be changed into cash within a year. Current liabilities. Debts that have to be repaid within a year. Fixed assets. Assets with a lifespan of more than 1 year. Liabilities. The debts of the business which provide a source of funds. Long-term liabilities. Debts that are payable after 1 year. The purpose of accounts. Different groups will want to see the accounts of the business to see information. Different groups require different information. Gross profit margin. X 100, the higher the better. Net profit margin. X 100, the higher the better. Over 10% is good. Profitability ratios. Measure performance of business. They focus on profit turnover and the amount invested in the business.